every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning from me, Peter Lewis. We've reached the middle of the week, Wednesday the 16th of August. It's a busy day for business and finance news, but we have it all covered right here on Money Talk, one of Hong Kong and Singapore's most listened to financial podcasts. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the People's Bank of China has surprised markets by cutting a key policy rate by 15 basis points. The PBOC injected 401 billion yuan into the banking system via its one-year medium-term lending facility at a rate of 2.5% versus the previous rate of 2.65%. This was the second reduction this year after the central bank lowered the rate by 10 basis points on June the 13th. Such a move is usually followed within days by a reduction in bank lending rates to households and businesses. China reported July economic data that broadly missed expectations. Retail sales posted the slowest growth since a decline in December, according to the official data. China's retail sales increased by 2.5% year-on-year in July, slowing from 3.1% growth in June and missing market estimates of 4.5%. China's industrial production increased 3.7% year-on-year in July, slowing from a 4.4% rise in June. And China's fixed asset investments grew by 3.4% year-on-year in the first 7 months of 2023, easing from a 3.8% rise in the January to June period, and also missing market forecasts. China has suspended publication of youth unemployment data, citing demographic and economic changes. The age 16 to 24 category has seen unemployment march steadily higher for 6 consecutive months to hit a series of record highs, culminating in a new all-time high of 21.3% in June. China started publishing youth unemployment figures back in 2018 for the first time. And the Japanese economy grew by 6% year-on-year during the second quarter, much stronger than an upwardly revised 3.7% expansion in the prior period. It easily topped market expectations of a 3.1% increase. And this was the third consecutive quarter of yearly advances and the steepest pace since the final quarter of 2020, largely supported by a strong contribution from net trade, with exports growing the most in 2 years. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and John Schofield, Managing Director of Tempus Investment. With a view from Japan is Nick Smith, Japan Strategist at CLSA. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks sank to a 5-week low as strong retail sales data raised concerns that US interest rates could remain higher for longer. The S&P 500 fell 1.2%, closing at 4,438 and ending the session below its 50-day moving average, a move that analysts often interpret as signalling the beginning of a downtrend. The Dow ended a 3-day winning streak, sliding 361 points or 1%, ending at 34,946. The Nasdaq Composite fell 1.1% to 13,631. Bank shares fell after an analyst from Fitch told CNBC that the agency was considering lowering multiple bank ratings. Shares of large lenders, including JP Morgan Chase, Citigroup and Wells Fargo, were down more than 2%, while Bank of America fell 3.2%, and the KBW Regional Bank Index shed 3.4%. Shares in Vietnamese electric vehicle manufacturer VinFast surged on its Nasdaq debut as the loss-making startup tries to crack the US market. VinFast went public by merging with a special purpose acquisition company. It opened at $22 a share from the $10.45 price the SPAC closed at on Monday, and it closed at $37.06. That's a gain of over 68% on its first day of trading. Longer-term Treasury yields hit their highest level this year following the economic data, which was stronger than expected. The yield on the 10-year US Treasury bond, which is more sensitive to expectations for economic growth, rose 4 basis points to 4.22%. That's its highest level since November 2022. The offshore yuan depreciated to around 7.32 renminbi per dollar, sliding to its weakest levels in over 9 months, as disappointing economic data and another central bank interest rate cut weighed on the currency. The offshore yuan has depreciated more than 5% against the dollar since the start of this year and is now near a record low. Hong Kong's Hang Seng Index slid 192 points, or 0.8%, to 18,581, down for the third straight session while approaching its lowest level in over a month. The Hang Seng Index has lost all the gains it recorded after the Politburo pledged pro-growth policies during its meeting on July the 24th. The Hang Seng China Enterprises Index, which tracks the largest mainland companies listed in the city, has plunged 7.7% so far this month to become the worst performer among 92 global equity gauges. And on the mainland, the Shanghai Composite dropped 0.1% to 3,176, sliding for the third straight session. And I'm afraid to tell you there's going to be more pain for Chinese stocks at the open this morning. Futures markets pointing to a loss for the Hang Seng of 272 points. That's about 1.5% at the open. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On this Wednesday morning, a pleasure to welcome my two guests. We have with us Capital Preservation Specialist at Financial Shield, Enzio von Pfeil. Morning to you, Enzio.
Morning, Peter.
And also with us, John Schofield, who's Managing Director at Tempus Investment. Welcome back, John.
Yes, hello, good morning, Peter.
Plenty going on in China and Japan to talk about this morning. So let's start in China. The PBOC surprised markets yesterday by cutting a key policy rate by 15 basis points. The PBOC injected 401 billion yuan into the banking system via its one-year medium-term lending facility at a rate of 2.5%. That's 15 basis points lower than the previous rate of 2.65%. This is the second reduction this year. The central bank lowered the rate on June the 13th. Enzio and John, what do you make of this? Is this sort of going to make much of a difference, or is it really a half-hearted measure here, given the poor economic data, which we're going to talk about in a moment?
Well, I think they have to do something, or be seen to be doing something, but it's just just trying to cushion the slide. I think really in the economy, and but what the real question is what's going to happen with how the government is going to address the growing debt crisis, which is spreading, as we see, from beyond the property developers into these wealth management trust firms and so on. Not to mention the local governments themselves, which are reliant on property, land sales for much of their income and so on. So we want to see what this task force that's been sent down to have a look at the wealth management firm. We want to see what sort of thing they're going to come up with in terms of restructuring proposals.
I mean, it's not too difficult for them, is it really? If they tell the truth, they should say what they really are. They're Ponzi schemes.
Well, you've got this... pretty more,
I'm sorry to be so blunt about it, but they are, aren't they? They're Ponzi schemes. I mean, any product that offers 8, 9, 10% returns when interest rates are below 2%, you've got to really question how they do it.
Well, I was going to talk about the nexus of an interconnected debt. I mean, you've got all kinds.
I'm digressing. I know.
Called a house of cards, John.
Yes. Yeah. But I've seen it. Triangular debt. That was a new expression to me that came out the other day, where everybody owes everybody else money. And going around in circles, yes, I suppose that's...
Well, money makes the world go round.
That's the definition of... Well, not in this case, because you've got to have new money coming in at the top of the system all the time to keep it...
feeding it, yeah.
Ponzi scheme.
Feeding it. And that suddenly... I mean, there's a certain amount of self-inflicted damage, although I think it's all inevitable anyway with the... you recall the 3 red lines which stopped people like Evergrande borrowing money from banks, instead of which they had to they started raising money from their suppliers by delaying, accumulating vast accounts payable.
Enzio, I mean, I'm feeling in a bit of a critical mood this morning, but nevertheless, these problems are self-inflicted, aren't they,
Totally.
in China? They are as a result of policy mistakes, bad policy decisions, and I get the feeling that the government is now being rather overwhelmed by all these problems that are escalating and mounting together and really doesn't know what to do about them, which is why it's tinkering at the edges with 15 basis points rate cuts.
I think it does know what to do. It goes back from economic policy just to the basic observation that it's confidence, not costs, that matter. In other words, if you decrease the cost of money by 15 basis points, so what? But if consumers and businesses have no confidence, then they're not going to do anything anyway. And the government has been singularly awful about how it's been treating the private sector, really, over the past years. They're kind of pawns on a chessboard, on a Ouija board, perhaps. And I think that's the root of the issue. The government's priorities have changed. It's security for some time under President Xi. That's fine and good. It's not growth. Everything economics has to be subsumed under national security. So, as Clinton would say in his day, it's the economy stupid. Well, in China, it's our security stupid that counts. And so until they decide to really encourage the private sector again with constraints, I get that, you're going to find this continued Japanization of the Chinese economy, which is quite dangerous from a geopolitical standpoint.
So what needs to be done? There needs to be some quite drastic changes, don't there? Not 15 basis point rate cuts, because that doesn't change the fact that people don't want to borrow.
Well, it's an attitudinal thing that, first of all, the private sector accounts roughly for 90% of employment and 80% of all investment. So if you keep on thwarting the private sector and saying, well, you can do this, but you can't do this, oops, no, we've changed our mind. This is exactly what my Professor von Hayek kept on saying, that if you don't have a stable business environment, people won't do anything. And that's exactly what we're seeing here, is that the companies, the private sector, can't do anything because its hands are tied. And until that happens, all these stimuli are going to go for naught. What John was saying, or what you were saying.
Well, let me carry on being critical, John, because, it seems that the government's answer to the problem is to try and hide from them. So yesterday they've cancelled publishing the youth unemployment data, presumably because it was too bad. But doing this doesn't really help the economy, does it? And the openness that the Chinese government says it wants to have in the economy, and it doesn't help attract foreign investors to come in when the data, crucial data on the state of the economy, is now being hidden from view.
Yes, well, I mean, foreign investors are effectively on strike now because, as you say, the words and the actions just don't match up. Whether it's coming from the top or whatever, but certainly the people implementing
Absolutely
haven't got the memo about encouraging foreign investment and treating them accordingly. And there's there's a clash with the security issue there, where they've decided that foreign investors who want to come in, they're not going to be allowed to see the books. They're not going to send in their people doing due diligence, or whether they use these consultancy firms onshore like Bain and Co, who are all I noticed slashing staff. Well, they have to, because there isn't the business coming in anymore. So yes, it is a question of attitude and policy. Just sort of going in a slightly different direction. I was rather, the one sector, of course, that is doing well is the exporters of electronic vehicles, solar panels, and wind turbines. And I saw the statement by the chief of BYD the other day. He said, "Oh, now we're going to, was it demolish the Western competitors?"
Now, isn't that an area then where, the youth unemployment, rather than ignoring it, because ignoring the data doesn't make all those people suddenly employed again, but nevertheless, you mentioned electric vehicles. This is an area where China has an edge. It's got big exports. Presumably, it's going to need trained people with particular vocational skills in that particular area. This is where they could make a dent, isn't it, into the youth unemployment figures?
Perhaps, but there's as we talked about last time, the actual capacity in China can produce 40 million vehicles a year, for which the domestic market is between 20 and 25 million. So that 15 million. So they already have the capacity. Presumably, is increasing automation and so on in that sector. So it's more a question of what you do with all these graduate engineer, trained graduate engineers. Maybe they certainly should be able to put to work somewhere in the economy, but I'm not sure that's the answer.
Well, Enzio, if you look at Germany would have had, if China was Germany, they would have had set up now vocational training centres in a flash to fill that gap and get some of these unemployed youth off the dole. Yeah,
I just don't understand why they don't just, also Hong Kong doesn't just use the German model as a plug and play. There's no invention needed. It works very well. Germany, Austria, Switzerland. And I think the other point being made is that there are roughly 12 million graduates pumped into China every year. That's what's happening. So, and then we haven't even, because we can't discuss the rural economy, that's another 900 million peasants running around. Because all these figures, as we all know here, really pertain only to the urban economy. So it gets back to my very simple point. Until you go more private sector, we encourage the private sector within bounds. I think they got out of hand, and that they threatened the power of the government, which I get some time ago. But until that happens, all of these stimulus measures are just going to go nowhere, basically.
Well, let's dig into the activity data that we had yesterday. There wasn't really many bright spots in it, if any at all, really, and quite a few downside surprises. Maybe the worst was the retail sales, 2.5% year-on-year growth. If you go back to April, retail sales growth was 18.4%. And now so this idea of a consumer-led recovery, it's looking rather forlorn, isn't it?
Well, it's also that the consumer in China apparently accounts only for about 1/3 of the economy, whilst in normal economies like the US or Europe or whatever, it accounts for about 3/4 of the economy. So until you get the consumer going again, but that's again all a function of job security. We even see that in Hong Kong. People are not going out and spending as much because they're not secure about their jobs.
John, where's the consumer gone?
Yes, that was, if you remember, the expectations, I think, before COVID and before all this security stuff, were that China would start to gradually transition away from, towards a consumer-oriented economy, and that's just been absolutely actually frozen and stopped. I agree with Enzio that there has to be a change. I noticed that that catering and so on did expand in the latest figures. So there are services,
some little areas, aren't there?
Including, yeah. You see the same pattern in Europe as well. Everyone's frantically travelling around, or restaurants and bars are full, even though we're supposed to be heading into a recession. But that just shows you that there is I think latent demand for this shift into consumer towards a consumer economy. So, as I was saying earlier, not only the domestic economy is still based on mainly on property and infrastructure investment, which is grinding to a halt, but also the manufacturing sector is still working on this mercantilist approach, exports and
that's if you look at the
export-driven and treating it as a zero-sum game, saying we're going to destroy the Western competition. I mean, that's hardly
it's not the growth policy.
Well, with the industrial production data, that slowed to 3.7% year-on-year from 4.4% in June. Year-to-date production at 3.8% for the second month in a row. No surprise there, really, is it? Because we know that people just don't want to buy things at the moment. They don't want to buy goods, as John said. They want to go to restaurants and travel.
Yes.
Yes, it would be interesting to see a breakdown of those figures. presumably we're talking about heavy industry as well. Steel and
steel
and all the rest of it, and that must be slowing because of the lack of activity in property and infrastructure.
Well, on the investment side, fixed asset investments slowed to 3.4% from 3.8% year on year. And within that, property investment, that slowed at an even faster pace. It fell 8.5% year on year. The previous month, the decline was 7.9%. Property sales growth, basically at a standstill in July. It rose only 0.7% year on year compared to a rise of 3.7% in June. So again, maybe no surprise, but it just highlights the difficulties, doesn't it, that these property developers like Country Garden now find themselves in. They just can't, even if they could finance themselves, they can't sell anything at the moment.
Yes, well, we need to get rid of the overhang of unfinished properties.
With white elephants also, yeah.
Yeah, there's a huge backlog that has to be cleared. So the property market needs a liquidity coming into it, but also needs to find clearing prices for a lot of the unsold stuff that already exists, and only then can you get the wheels turning again.
Yeah. So the big question then, Enzio, that everyone's asking in the market, does this mean the PBOC is going to undertake some form of stimulus, quantitative easing, whatever you call it, and is that even the right thing to do?
Well, I'm sure it will take that step. It's been doing these sort of baby steps on it anyway. But again, I think it's totally misdirected. It's a little bit like telling an alcoholic to stop drinking by eating more vegetables. It just doesn't. There's no.
Doesn't work.
Doesn't make any sense.
Yeah. And if you want to make this transition to presumably a less debt-fueled economy, which is what the government says, increasing debt is not really the answer, is it?
Yeah, nor is common prosperity. I don't understand how people get more prosperous by being unemployed, but maybe I went to the wrong economics school.
Don't get me started on common prosperity. I've said enough already this morning. John, what do you think? First of all, are we going to see stimulus? Secondly, do you think it's the right thing to do?
Probably limited stimulus, and as we've been discussing, I don't think it's not really the answer. It's just cushioning. Quantitative easing. How about sort of going into the market and buying up all the bonds from the property
developers,
and then
they might have to
then putting nationalize some of the debt and presume temporarily nationalise the developers, restructure them, and then
sell them off later.
Yeah, and sell them off later.
Yep. Well, you could do that not just with
sensible.
You could do that with a lot of companies, couldn't you, on the mainland? Not just property developers. I mean, there's plenty of state-owned enterprises. You could follow the Indonesia route and say, why do we need to own all these companies? Why don't we start privatising them? But of course, that goes against totally the philosophy of the Chinese Communist Party.
Yeah, that's very much also at the root of this, I think, and they want to remain in power, which I get. They've also done some pretty good things over the years. Let's keep it in perspective, but I think it's ultimately it's a power game.
Well, the market implications of this, John and Enzio. First of all, the yuan. The yuan is at a 7-month low, the lowest since a 9-month low, the lowest since November. The yield on the Chinese government bond, 10-year government bond, is at a 3-year low at the moment. Presumably, we're just going to see a long, drawn-out decline in both, aren't we, at the moment, on the current trajectory we're on?
Yes, I think so. That would be my take. I mean, again, I don't think there will be many foreign investors interested in buying, yuan bonds, I think the currency is probably going to continue to weaken. Partly the counterpart, of course, of the strength of the US dollar. The exporters won't be too bothered about that, I suppose. But,
no, not in China.
But
not in any low-cost producing economy. That's where the exchange rate really counts. But once the higher up you get in the value-added chain, the less the exchange rate actually counts, in my mind.
Enzio, tell me about your economic clock and what it's saying about China at the moment.
Well, disaster. It's it's saying that there's an excess supply of money, which we all know about. It's sloshing around in liquidity, but normally that would lead to an excess demand for assets. But because there's an excess supply of goods, in other words, just too much stuff, nobody buying, inventories going through the roof, I'm sure. The economic time, on the face of it, looks very good, but in actuality is exactly what we had in Japan 30 years ago. And that, until this fundamental policy shift happens, simply cannot, by definition, change. So it's excess supply of money, excess supply of goods is the economic time.
So is your economic clock partly, is it in effect measuring money supply, looking at money supply in the economy?
Yeah, it's all a bit fuzzy. It's money supply relative to economic growth. And that's then where, because if you take economic growth as your sort of demand for money, then you can say, well, if the supply is growing faster than the demand for money, then you've got some form of liquidity, in other words, excess supply of money around. In the U.S., which I realize we're not discussing at present, they do have a very good financial conditions index by the University of Chicago, which continues pointing to more and more easing, but we'll get on to America's monetary tightening perhaps later on the show.
So what is a bit odd there then is if money supply in China is increasing, which is being reflected in your economic clock, an excess supply of money, why isn't inflation going up? Because the two normally go hand in hand.
No demand. Because again, because there's no confidence, people aren't shopping. So they're just basically hoarding cash, and companies are hoarding cash. And because there's no job security, people are saying, well, I know that I've got this packet full of money here, but because I have no job, I'd better live off the cash.
Right, understand.
But it's a very good question, yeah.
Okay, well, let's cheer ourselves up because the Chinese economy is a bit depressing. We're going to have to switch to Japan to do it, though. The Japanese economy grew by 6% year-on-year during the second quarter, much stronger than the upwardly revised 3.78% expansion in the first quarter, and easily topped market expectations of 3.1% increase. I mean, John, you don't often see a developed market economy growing by 6% like that, do you? How has this come about?
Well, it may be a bit of a one-off effect, but partly helped by the increase in tourism, and I think the reforms that have come through so far in the industrial corporate sectors, where we've seen a lot of investment coming in from overseas, quite opposite to China, and Japan has got a top class. High technology and related industry base, and all those, similar to, not dissimilar to the US. In fact, in some respects, it doesn't have quite the leading edge stuff like NVIDIA, but they're major contributors to that in that sector as well.
Enzio, what's your economic clock saying about Japan?
Excess supply of money and a looming excess demand for goods. Now, when I say excess demand, it doesn't mean that it's going through the roof, because the Japanese are very conservative. The wages rose by 1.8% year on year in May. Now, that's a low number, but it's the biggest gain since February of 1995. That's the biggest gain in 28 years in wages. So a portion of that's the consumption side, will be spent because job security in Japan is rising whilst it keeps falling in China. And so I think that you'll find this, when I say excess demand for goods, it's not that too much money is chasing too few goods, because there's still a lot of slack in the system, but it's all on the right track, let's put it like that.
So the only problem is, though, with the caveat on that wages, is real wage growth is still negative for Japanese households. So presumably they're not feeling particularly rich at the moment, I should imagine, which may be why, because the blot on this data was consumer spending actually declined by 0.5%. Presumably that's one of the reasons why.
Absolutely, and I think, again, I can only, with the clock, what we're really trying to do is just to get it's a bit like a compass, just to get the directions of going northeast or southeast kind of thing. But again, when we talk about excess supply, excess demand for goods, that's still quite some way off, because the Japanese are also by definition very conservative consumers. They're not like the Americans who go and spend before they have.
But if your economic clock is pointing to an excess supply of money in Japan, and contrary to China, a looming excess demand for goods, that presumably is inflationary, isn't it?
It will, yes. It depends. But there's also again with the very simple argument that too much money could be chasing too few goods if they don't up the production. But at the same time, you also have supply side inflation, the rising costs of certain inputs like lithium and stuff like that. The falling yen is, of course, also going straight into your wicket. Peter has been fanning imported inflation because you're sending more and more yen. What's the rate now? About 114 to the dollar kind of thing.
140, 145.
145. Excuse me, 145. Good Lord, yes. It's just how dated I am on that. Yeah, that was last year. Like I said, it's looming. But. Yeah, so that's going to be driving some imported inflation, but also just oil, the weather. We all know about the weather. Well, that actually does surprisingly drive up agricultural goods. So these are things that monetary policy cannot address. That's been my long wail about the Fed.
But I think the Bank of Japan wants to hear you say that this is inflationary.
Yes, well, yes, I would say it is inflationary, Bank of Japan.
Okay. John, how much of this is down to the weak yen? Presumably that's making a difference, isn't it, and making exports more attractive? Because on the export side, Japan has done very, very well, hasn't it? Net exports contributed 1.8 percentage points to the expansion, almost double what economists were expecting.
Yeah, I'm sure that weak yen's a factor, but just going back to the monetary policy. I still think Japan has is in a bind here, or the Bank of Japan is in a bind how to get out of this, because it's a bit of they want inflation. They seem to be quite happy with 3 point or whatever it is now, 3.2, but probably rising. But Japanese workers and consumers are not happy with this level of inflation. To both stabilise the yen and make sure that inflation doesn't continue doesn't get out of control. They need to start raising interest rates. Basically.
Yeah, and basically end the yield curve control. That would send the yen through the roof, wouldn't it?
Well, I think they need to send a signal at the short end as well. I mean, it's ridiculous having negative interest rates in 2023.
Yes.
And they're the only country that has that.
And they loosened the yield curve control a little bit, didn't they, John?
Yes,
but I mean, it's still all tinkering at the edges.
Even that minor tinkering. I think the tinkering is, the bond yields, 10-year bond yields gone from 0.5 to 0.65, something like that.
Took a bit of a lurch.
Whereas in the meantime, U.S. Treasuries yields have, gone up by
4.2,
gone
last
up
year
by far more, and looks like heading in that direction. So that's and don't forget they've got this effectively moribund government bond market, where everything goes around. Most of it's owned by. Half of it, I think, is owned by...
More than half. Yeah, I think it's about 55%.
By the Bank of Japan itself. So there's a kind of weird, circular thing going on there.
Enzio, I want to come back to your economic clock. Tell me what it's saying for the United States.
Excess demand for money is going to start coming into this, and the excess supply of goods will then translate. This is going more into the election year, I think. That you will find the rates rising both at the long and at the short end in the U.S. The short end, because the wages are actually growing by a quite astounding 5%. The average has been like 1.6%. So the wages are growing very strongly. We know the American penchant for consuming, in other words, consume before you earn. So that will continue until the rates go so high, also on the long end, and that's because you're going to find a clash. If the government may have stopped buying all these bonds, getting bonds, giving money into the system, it may have stopped that, but with the debt levels rising and with the debt level ceiling having been lifted, you'll find even more demands for federal debt, and so you'll find the issuance of bonds rises, supply rises, surprise, the bond price falls, and thus the bond yield rises. So it's an upward shift on both the short and the long end, in my mind.
Sounds like this is inflationary.
Yes, it is. But again, I would caution that 1/3 of this, is again driven by these demand factors like food and like agriculture and so on. One always just wants, and also even in the labor market, it's very important to remember that a lot of people these days, contrary to our generation, don't want to work. So when they say we've got tight labor markets, well, hell, if nobody's wanting to work,
or they want to work in a different way, maybe by being self-employed, and in that way, rather than going to the office.
Podcasts and things like that.
Exactly.
And also, there's a new way of working called working less. That's a new way of working. So
working more efficiently, maybe.
More efficiently, perhaps, yes. Although it was interesting that the U.S. military decided that instead of sending its emails efficiency to .mil, it decided to send all of its emails to Mali, .mal, and that was not so precise. So the Mali people now have all of their defense plans, their tax bills, and all this kind of stuff. That's one up for American efficiency. As many good things as America does have.
I mean, one of the things we should mention here, that while interest rates are going up and while there's been this tightening, the Fed is also shrinking its balance sheet as well, isn't it? It's sold $1 trillion of bonds off its balance sheet in the first part of this year, and presumably that's going to increase, isn't it, over the second half of the year?
By 2025, they will do another $1.5 trillion of shrinkage of the balance sheet, that then means that the Fed funds could well rise by another 0.4% on top of the current level. So I've always been feeling that they would go more up to 6%, whether it's 5.5 or 6, it doesn't matter. But that again, it ties into that. But John, you were going to say something.
Yeah, the one thing I would say about the Fed in recent times, that's to say the last year and a half or so, they've been very consistent. So this. They're not selling, actually, the holdings of securities. They're just allowing to run off as they mature.
Yes.
And they announced a plan 18 months ago that they were going to let it run off at 90, I think it's 85 or 90 billion a month. And they've just stuck with that. And so we've already got, from a 9 trillion balance sheet, it's now down to slightly less than 8, I believe.
Yes.
And, which is still far, far higher than it was before COVID.
Again, excess of
the market has handled it very well, hasn't it? This run-off
so far, and I think the fact that the dollar is strong and people can earning these. The short end, people are now getting 5.5%, so that's fine, and there's unlike many market participants desperately trying to forecast when they're going to start cutting rates. I don't think there's anything like that on the horizon.
Where are you putting them, John? Are they going to plateau? At what level do you think the Feds?
They said they would get to here. Going back to the consistency thing,
yes,
we've got to exactly where they said they were going headed, more or less a year ago. But,
yes,
in step paces. So. We'll see what they say in September, but I think they will just keep their options open. I wouldn't be surprised to see another quarter point or something.
Yes.
In September, they've really got to knock the inflationary expectations on their head. I think, and I'm not convinced they've yet done that. Meanwhile, the long end, the long end will back up. Part of normalisation is to have a normal yield curve. Positive yield curve.
Yeah.
It currently has got this weird kink in it at the 10-year.
The belly of the curve, as they call it.
I'm not sure why that is, but I think the runoff of the Fed's balance sheet will probably cure that.
That's a good point.
And very quickly, where do you think Fed rates are going to get to?
I think more, if this view holds of this IMF economist, that another 1.5 trillion will in reduction runoff on the bonds will lead to another 0.4% in yields, and they're currently at 4.25, I believe, and I think they would go to 4.65 to be desperately precise. That's not really the point. That more closer to 6 than certainly to 4.
Okay, well, thank you very much for your thoughts. Very interesting discussion this morning. You heard capital preservation specialist at Financial Shield, Enzio von Pfeil, our regular Wednesday commentator, and John Schofield, who is managing director at Tempus Investment.
Talk.
I'm joined now by Nick Smith, who is Japan strategist at CLSA in Tokyo. Morning to you, Nick.
Good morning to you.
Well, look, the Japanese economy grew 6% year on year during the second quarter. That was much stronger than the 3.7% expansion in the prior period. Beat nearly every single economist's expectations. The average was about a 3.1% increase. Nick, how on earth has that come about?
Well, I think most people forget that tourism is booked in exports. And so you're going to read people saying Japan's over-dependent on exports, that it was all about the yen, and it wasn't. It was all about tourism. I mean, I think as far as a economist is concerned, he's just not used to tourism moving the needle. And it took, obviously decades to get tourism up to, I think it was 0.8% of GDP in 2019. So it's gone from zero to that approaching 0.8 over a period of just a few months, and that I think is what's confused people. But obviously, the point is that we got the announcement last week on the 10th of August saying that China is removing impediments to group tours, and so that should add to tourism going forward. We're getting new numbers out for tourism for July today.
Yeah, but it got back the last figures that we saw from the National Tourism Authority said that Japan's recovered to more than 70% now of its pre-pandemic levels, which is much better than a lot of other countries.
It certainly has. I mean, obviously, the weak yen helps in all of this, and it's not just the yen itself. It's the fact that prices haven't moved in Japan since before some people were born. So, in geek terms, that's the real effective exchange rate is back to 1972 levels, I think.
Right. But I know you mentioned that, people wrongly think that this is all about the weak yen and exports. Nevertheless, exports did contribute quite well to this, didn't they? Net exports added about 1.8 percentage points to the expansion. So this has made a difference, and I presume particularly for cars.
Well, that's true. Yes. So, as I say, tourism is a large part of that exports number this time, and yes, autos was a big surprise. I was just, as I was going through the quarterly earnings numbers, I was blown away by just how strong autos had been. We knew that they'd had supply chain bottlenecks. We knew that there were other problems, but that came snapping back. I think the volumes in autos were approaching was it 30% year on year. So the volumes were good. What was particularly impressive was pricing, and for most of the auto companies, pricing was the biggest contributor to profit growth.
And I suppose it's also worth mentioning that the Japanese economy is now the largest on record. It's about $3.85 trillion. That's about 561 trillion yen, the biggest on record, and presumably only going to grow because the IMF is forecasting growth for the whole of 2023.
Well, that's right. So people are revising up GDP numbers. I think there are concerns about the rest of the world, particularly Europe's looking horrible at the moment. So Japan within all of that looks attractive. Obviously, as an equity guy, I'm far more interested in what's going on with profits, and profits in Japan have been on an absolute tear. They trounced the consensus numbers in the June quarter. They've revised up numbers for the full fiscal year and the next one, and that's been backed up by companies hiking guidance. And in Japan, it's pretty rare for companies to hike guidance just one quarter into the fiscal year.
Right. I want to get your thoughts on the market specifically in a moment. Before I do that, can I just ask you, how is the Bank of Japan likely to take all of this data?
The Bank of Japan has been trying to have it both ways. So obviously, a couple of weeks back, the BOJ increased its yield curve control ceiling up to 1%, but it's still buying bonds heavily to try and hold down interest rates. So it said it wouldn't move its forecast, and then it did. I think inflation is coming in a lot stronger than they'd expected. They said it was imported. They said it was transitory, and I'd said all the way through it's neither of those. And I think they'll be dragged kicking and screaming into loosening things up going forward. So you look at futures, and they're suggesting that that the short end might get a bump up within the next sort of 6 to 9 months also.
Am I right in saying that the Bank of Japan, I mean, certainly in my view, is getting its messaging terribly muddled at the moment about what exactly it wants?
Well, that's right. I mean, obviously, central bankers like to try and tell you that they're sort of engineers and they're moved by the numbers, but the dirty secret is, of course, it's very a political institution everywhere, and the government would like to spend like drunken sailors and have its money printed for them in perpetuity. And the Bank of Japan, I mean, I've compared this to the 1930s situation where they did extreme money printing, and the result, of course, was
not very good, was it?
It was hyperinflation. So yeah. It's very difficult to turn around and say no to government, but this is why this governor was the only person who wanted the job, and a lot of others said thanks, but it's a poisoned chalice.
And obviously inflation is going up in Japan, but as you've said many times on this programme, when you look at inflation in Japan, you've also got to look at wages as well. And although wages are going up, there's still real wages are negative, aren't they? Maybe not as much as they were before, but so presumably the Japanese consumer, the Japanese household doesn't feel rich yet.
No, I don't think it does. I mean, if you look at OECD numbers, then wages in Japan have been basically sideways for 3 decades. And so we always used to talk about fantastic Japanese employees and coming up with so many ideas of their own. And then everyone's now saying, well, look at the decline in productivity. And I suppose the answer is, well, that's going to happen if you don't pay people properly. We pretend to work and they pretend to pay us.
And presumably that's one of the reasons why consumer spending in this GDP number, that was the blot really on the copybook, wasn't it? Because it was negative. Consumer spending dropped about 0.5%. Presumably that is linked to the fact that real wages are still negative.
On the face of it, yes. Now, as perhaps you know, Japan's got the biggest revisions on GDP of any G7 economy. And that's because they just can't get consumption right. And it's based off a survey of 9,000 people. So it just blows you away, doesn't it? The idea that 60% of the economy is based on a survey of 9,000 people. So they tend to revise it a lot. My feeling is there's a better series that comes from the BOJ that tries to correct some of these problems. That's somewhat more positive. So in the rest of the world, what we saw during COVID was that there was revenge spending when people came out of it, as they were spending the money that had been piling up over months of not doing anything.
So tell me, what does this all mean for the markets? First of all, with the currency, the yen has slipped now below 145. Presumably at the moment, unless the Bank of Japan changes course, it's just going to be a long downward decline for the yen.
Yeah, I mean, obviously a large part of this has been what the dollar's been doing. There have been expectations that the Fed would be cutting rates, and instead it's been hiking them. And so that's an issue over the next few months. As we get into next year, I'd have thought that there'll be much more trading on expectations of the Fed cutting rates. There'll be upward pressure on Japanese rates. And I think the yen will strengthen somewhat, but that's probably going to take until next year.
Problem is, if you look at the 10-year Treasury bond yield, it's well above 4% now, isn't it? It's not really sustained a rise above 4% since the global financial crisis, but it's doing it now. So that widens that yield gap with Japan, puts more pressure on the yen.
I think so. That's only a short-term thing. I would have thought it'll start to reverse as we get into next year. But yes, Japan is the real standout on that, isn't it?
So what does this mean then for stocks? If we take the situation as it is, inflation is going up in Japan, but the Bank of Japan sees it as being transitory and imported. Wages are going up, but real wages are still in decline. Where are the sectors that you look at within Japan that can be the beneficiaries of this scenario?
Well, I think with those concerns about slowing growth, particularly in Europe, which looks something of a basket case at the moment, then the focus should be on domestic much more than exporter stocks or overseas stocks. Your focus should be on dividend yield, because I think there's a real yearning for yield at the moment with rates so low. I think one of the areas that I've been focusing on is the extreme labour shortage. And you always get people saying, but why don't they just increase immigration? Well, I'm afraid they can't, because wages are just so lousy here. In which case, I've been concentrated on, for example, those that benefit from the labour shortage, which is in staffing and recruitment, but also in areas like labour-saving devices, in automation and so on.
And let me ask you about banks. They're normally quite highly correlated, aren't they, to movements in interest rates and JGB yields. What do you think about them? And insurers maybe as well?
Absolutely, yes. So I had been saying that there was a strong probability of an increase in the yield curve ceiling at the last BOJ meeting. I was probably the only one who was saying it, but fortunately I was right, and banks have done quite nicely from that. The yield hasn't risen as much as I'd hoped. I think it'll be a slow burn on that, but I think banks are just so incredibly highly geared to movements in bond yield that will get continued outperformance on them through the rest of the year. Insurers are also a play on that. They're not as highly correlated with yields. They're not as geared to it, but they do look interesting.
Nick, it's always a pleasure talking to you. Thank you very much for that this morning. That's Nick Smith, who is Japan strategist at CLSA in Tokyo.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Econosis Advisory, and Nick Marrow, lead for global trade at the Economist Intelligence Unit. And discussing the latest developments in the oil markets is Vandana Nahari, founder of Vanda Insights. See you tomorrow.
Money Talk.